I will be speaking today on the monetary policy framework in India. I'll just share my screen with you. Yeah, so I will be speaking on the monetary policy framework in India. Now, this topic is important for two reasons right now. One is that in 2016, the monetary policy framework moved towards flexible inflation targeting, and a six-member monetary policy committee was constituted for setting the policy rate. With this step towards modernization of the monetary policy process, India joined the set of countries that have adopted inflation targeting as their monetary policy framework. So as a target for the headline inflation, the consumer price index was chosen and a tolerance band was stipulated for the movement in the inflation rate of 4% plus minus 2%. So the mandate of the Monetary Policy Committee was to maintain the inflation within this tolerance band of 4 plus minus 2%. Now, so this is one reason why this topic is important. This mandate of the inflation rate was set from August 5, 2016 to March 31, 2021. So we are nearing the end of this mandated period. So it is a good idea to reflect on how this framework has moved forward, how it has influenced economic activity in India. Now, the second reason, as you all know, we have faced an unprecedented, extraordinary humanitarian crisis. And while the crisis was a health crisis, a human crisis, it has severely impacted the economic and financial scenario across the globe. So in this scenario, how do we manage monetary policy? What can we do about growth in the economy? How can we revive economic growth? How can we mitigate the impact of COVID-19? And how can we restore or ensure financial stability? So these are very important issues that have been debated, have been implemented also. So I will touch on some of these issues and also discuss some of the unconventional measures of monetary policy that have been adopted to mitigate the impact, the economic and financial impact of COVID-19. And what I will also show is the synchronized actions across the world of all countries in their policy making in tackling this extraordinary crisis. So we will look at that as well. So these are the two reasons why this topic is extremely important right now. And what I also want to say, especially to the students, is that what I'm going to present is already available on the internet. It can be downloaded, and therefore you don't have to worry about taking down notes. And if you miss something, you will get everything in black and white. So just relax and just listen to me like this is a story. And then you can later on check the facts. So what I'm going to do today is to go over the genesis of the monetary policy framework in India starting in the mid-1980s. So I start with the monetary targeting framework with feedback, which lasted from 1985 to 1998. Then from 1998 to 2016, we had the multiple indicator approach. So I will describe the multiple indicator approach and then describe why we moved towards flexible inflation targeting in 2016. What was the recommendation and what were the factors that influenced this decision to set up the Monetary Policy Committee and to have the flexible inflation targeting. So we will look at some of the recommendations that were made by the expert committee that was formed to strengthen the monetary policy framework, and that gave its report in 2014, based on which we had adopted the flexible inflation targeting framework. Then we will look at the amendments to the R.B.I Act that were made to adopt statutorily the monetary policy framework. And then we will look at various aspects of the Monetary Policy Committee, which was constituted in September 2016, and it had its first meeting in October 2016. To date, it has had 24 meetings. That's a 4-year term. So that is a full 4-year term. We have completed 24 meetings. Then I will also reflect on the monetary policy transmission process. What is monetary policy transmission? Monetary policy transmission means when monetary policy changes, how does it impact economic activity? How does it impact inflation? So we will look at this process. We will compare the Monetary Policy Committee in India. This was the first time that the committee was set up in India in 2016 with monetary policy committees in various other countries. How has it performed? Is it different from the others? So we will look at that. And then we will also look at inflation targeting in other countries. And then to wrap up everything, we will look at what has happened at the global level in terms of the slowdown, in terms of the COVID-19 pandemic, and in terms of the policy making of central banks, and also a little bit about fiscal policy. So this is, in a nutshell, my presentation. So I start with what is monetary policy. So monetary policy refers to the policy of the central bank with regard to the use of monetary instruments under its control to achieve specified goals. And the Reserve Bank of India is vested with the responsibility of conducting monetary policy, and this is defined in its Act of 1934. Now, the preamble of the R.B.I Act 1934 was amended in 2016. So the amended preamble reads as follows: to regulate the issue of banknotes and keeping of reserves with a view to securing monetary stability in India and generally to operate the currency and credit system of the country to its advantage, to have a modern monetary policy framework to meet the challenge of an increasingly complex economy, and to maintain price stability while keeping in mind the objective of growth. So this last sentence, to maintain price stability while keeping in mind the objective of growth, is a very important mandate of the Monetary Policy Committee. So now if we talk about operating the currency and credit system in an advantageous manner, what do we mean? So we mean that we have to utilize the credit and currency systems to promote economic growth. We have to create money supply such that this does not jeopardize price stability, and at the same time we have to maintain foreign exchange at a level that will help ensure that the exchange rate does not exhibit volatility. So in terms of exchange rate, we simply have to ensure that there is no excessive volatility. And then to repeat, the primary objective of monetary policy is to maintain price stability, keeping in mind the objective of growth. This is very important. So before I go into the monetary policy frameworks that we've had since the mid-1980s, let me very quickly give you a schematic representation of what is a monetary policy framework. So in a monetary policy framework, we have instruments, operating targets, intermediate targets, and goals of monetary policy. Goals of monetary policy: economic growth, price stability. So also we can add financial stability, we can add exchange rate stability. So all those are clear to us. But how do we achieve these goals? So what are instruments? Instruments are tools that are under the direct control of the central bank. So the central bank can use these tools to influence operating targets. So instruments would be variables such as open market operations, policy rate. So this the central bank has total control over. Now, operating targets are financial variables that are impacted by instruments and that help to deliver the goals of monetary policy. So operating targets are managed on a day-to-day basis. So this is the difference. This is a day-to-day basis management of these variables. So if we have operating targets, we can have examples like reserve money, we can have short-term interest rate, so that is managed on a day-to-day basis. Then after that comes intermediate target. So we're getting closer and closer to the goals of monetary policy. So intermediate target would be something that takes us straight to the goals of monetary policy. So intermediate target would be things like the broad money, or if we look at the entire spectrum of interest rates, and all that takes us to our final destination of the goals of monetary policy. So within this framework, we will study the three monetary frameworks that we have had since the mid 1980s, starting with monetary targeting with feedback. So if we look at the monetary targeting with feedback framework, what really happened in the 1970s up to the middle of 1980s was that there was monetization of fiscal deficit and inflation was very high. And every attempt was made to control inflation, but inflation was out of control. So around that time, a committee was set up to review the working of the monetary system. And the chairperson of this committee was Dr. Sukama Chakravarti, and he recommended in 1985 a new monetary policy framework which was based on monetary targeting, and this was based on the assumption of a stable demand for money function. So in this, what was done was that broad money was chosen as the intermediate target, reserve money as the operating target. And this system was called monetary targeting with feedback because a range was given for broad money. So depending on what output growth was, the broad money growth was changed according to that. So there was some provision for flexibility. So here is the monetary policy framework, the instruments, operating targets, intermediate targets, and goals in this framework. So I'm not going to get into the details here, but these are all given in my paper, which is downloadable. So you can look at it there. So what really happened in this framework was that the money growth outcomes were far from the targeted outcomes, the targets that were made by the central bank. And even though CRR was raised to very high levels, it was not possible to control inflation. So this system did not really work out. And then another thing that happened in the 1990s was that there were several financial innovations, like rapid use of credit cards. So what that implied was that demand for money no longer was stable. And other things that happened around this time was that India was very rapidly integrating with the rest of the world. So this meant that India was exposed to global influences, whether it was capital flows or volatility in exchange rates or global growth. So all these factors became very important in determining India's growth. Then at the same time, interest rates were deregulated. So there was provision for changing interest rate. Another factor that happened at this time was that the exchange rate also was partially market determined. So exchange rate could also change. So what was decided at that point was that we should look at several variables in determining monetary policy, not just the money supply growth and output. So in that sense, a host of quantity variables were selected, and everything that you can think about: money, output rate, capital flows, fiscal indicators. Then a lot of rate variables were also selected, like interest rates, inflation rate, exchange rate, and all of these were combined. And then as we moved along, it was also decided that we should be looking to the future. So we should take expectations into account. So around that time, the Reserve Bank of India started several expectation surveys. So it started surveying industry people, it was surveying households for their inflation expectations, and also it started consolidating the survey results of various professional forecasters in the country and seeing on average what the forecasts were for various variables for the economy. And so it was decided that we would take lots of the variables, the quantity variables, the rate variables, the expectations variables, and then what we would do is we would use some time series model, and based on that, we would make projections of growth and inflation. based on the econometric model. And the projections for broad money, which was M3, was given by the central bank. So we had the projections for growth and inflation, and then on that we superimpose the projection for money growth, and then on the basis of that we determine what is the monetary policy action. So this framework continued till 2016. So if you look at the top panel, so that is all the variables that were taken into account. So we had the rate variables, the quantity variables, forward indicators, put everything into an econometrics model, and we came out with outlook projections for growth and inflation. On that we superimpose what the central bank gives us as the monetary projection, and then based on that we decide what is the monetary policy action. So this lasted till 2016. So around that time, before 2016, in 2009, a committee was formed on financial sector reforms with chairperson as Dr. Raghuram Rajan, who later became the governor of the Reserve Bank of India. So this committee then decided that it is best to focus on controlling inflation. So central bank should control inflation. And why is this? Because the cause of inclusion can be best served by maintaining this focus, because the poorer sections are least hedged against inflation. So awareness about inflation was coming as early as 2009, and therefore this marked a major step towards flexible inflation targeting. So then Dr. Raghuram Rajan became the governor of the Reserve Bank of India, and under his governorship, he appointed a committee, an expert committee, to revise and strengthen the monetary policy framework. And the chairperson of this committee was Dr. Urjit Patel, who was the then deputy governor at Reserve Bank of India. And this committee then recommended the flexible inflation targeting approach, which was then adopted in 2016. And when it was adopted, at that time, Dr. Urjit Patel was the governor of the Reserve Bank of India. So you can see how this is happening, how this is evolving over time. And these are the terms of reference of the committee. And some important things that the committee had to decide was that what is the nominal anchor for monetary policy? What is the meaning of nominal anchor? Nominal anchor is we have to give some numerical value to a nominal variable, which will help us to keep prices stable. So we have to identify a variable and give some numerical value to it. And this committee identified that variable as the inflation rate. So regarding the inflation rate, then the committee had to recommend which inflation rate to use and what is the quantitative target that we should aim for. So just to give you a little bit background, so the nominal anchors that were discussed by the committee were monetary aggregates, exchange rate, national income, price level, and inflation. And for monetary aggregates, the committee rejected this as a nominal anchor because the money demand function is no longer stable. Then exchange rate it rejected because the country then becomes vulnerable to global shocks, which we don't want. Then it rejected national income or GDP targeting as a nominal anchor, because to do that, the central bank has to have some notion of the target of GDP growth, which is difficult to do. And then price level, the committee said there's no point looking at the price level, you might as well look at the inflation rate. And therefore, inflation rate was chosen as the nominal anchor. This is well understood by the public, and it increases the transparency with respect to the workings of monetary policy. And also it helps to anchor inflation expectation, which is very important. So it went with inflation. And what this did was that it became clear that we are moving towards the flexible inflation targeting, which is recognizing the existence of a growth inflation trade-off. It is also recognizing the importance of anchoring inflation expectations And also, this is consistent with having some flexibility in exchange rate management. So these were all positives in this approach. And then the next task of the committee was to choose which measure of inflation to use, whether we should use consumer price index, if consumer price index, then which version of consumer price index, or whether we should use the wholesale price index. And wholesale price index was rejected because it does not cover the non-commodity producing services, which is a large part of the consumer expenditures. And so it went with the consumer price index because that reflects the expenditures of large segments of the population. And this is the inflation that consumers face in the retail market. And therefore, within the consumer price index, it shows the overall combined inflation, which covered the urban sector and the rural sector. Then there was some more discussion that whether from this overall inflation we should remove the food and fuel component, which brings us to core inflation, because some people said food and fuel, because it's very volatile, so we should not have that as our target. So we should take CPI and subtract food and fuel from there. But then if you subtract food and fuel, that's more than 50% of a consumer's basket, and therefore that does not make sense. So what was finally used was the CPI reflecting both rural sector and the urban sector, and that's what it went with. And the last thing was that what should be the target for inflation. Target I already gave you earlier, that this was stipulated by the government of India as 4%, a plus minus 2% tolerance band. So this was the framework that was adopted in 2016. And for this, amendments were made to the R.B.I Act. But before the amendments were made, we had a signing of the Monetary Policy Framework Agreement between the Government of India and the R.B.I in February 2015. And after this signing, the flexible inflation targeting was formally adopted in India. And then what happened in 2016, in May 2016, was that the R.B.I Act was amended. And with this amendment, the implementation of the flexible inflation targeting framework got a statutory status, and therefore this could then be implemented. And what was done was, as I said, the official gazette notification was taken out regarding the inflation rate of 4% plus minus 2%. And this was the mandated inflation from August 5, 2016 to March 31, 2021. And also the amendment made at that time was that there would be a monetary policy committee with 6 members, 3 would be external, 3 would be from the central bank, with the governor of Reserve Bank of India as the chairperson. So, so the committee was formed, and the framework that was given to the committee was that the committee has to set the policy rate. The policy rate is the repo rate. And to set the policy rate, the committee has to assess the current and evolving macroeconomic situation. And then it has to modulate the liquidity conditions to anchor money market rates around the repo rate. So it sets the policy rate. Then at this rate, it makes sure that the operating target, which is the weighted average call money rate, stays around the repo rate. And it makes sure it stays around the repo rate with liquidity management, which is done on a day-to-day basis. And then what is expected is that this weighted average call money rate will then affect the entire spectrum of interest rates, including the money market, bond market, and the banking sector. And having affected the entire maturity spectrum of interest rates, this will affect aggregate demand in the economy, and therefore it will affect consumption decisions, investment decisions, net exports, and therefore output growth and inflation. So this is what was our mandate, to set the policy rate, and then this policy rate is expected to have a magical effect through the economy. So the committee itself, as I said, had 6 members, 3 external and 3 internal from the Reserve Bank. And the committee was to meet at least 4 times in a year, but it actually met every other month. So it met 6 times in a year. And the soon after the end of the meeting, each meeting was a 3-day long. So soon after the end of the meeting, the resolution of the meeting was put in public domain. And then on the 14th day after the meeting, the proceedings of the committee are published. So the proceedings contain the statement of each and every member of the committee, why they voted, how they voted. So there is complete transparency in this system, and this system is actually much more stringent than the system of many other countries, because each member has to say why they have voted for a particular change in the interest rate, and that makes us or all the members very accountable. So the first meeting of this committee took place in October 2016, and before 2016, the Reserve Bank had what was called a technical advisory committee, but this committee had a more advisory role. So it used to advise the governor on what the interest rate should be, whereas the Monetary Policy Committee actually set the rate. So it's not advisory, it actually made the decision regarding the interest rate. So that was the difference. Then how this monetary policy framework has worked. So we had the instruments. If we look at the policy rate, now this policy rate changes. It changes the short-term interest rate, which is the weighted average call money rate. And then with this, all the short-term and long-term interest rates are changed in the economy. And this then affects the price stability and economic growth in the economy. So this is the way it was to work. And how we determine the interest rate in each meeting. So each member had to vote, like, I want interest rates to go up by 25 basis points, and what is my stance. And the beauty of this voting process was that each individual could express their own assessments of the economy, their own expectations, and their own policy preferences. So what I have done here is summarized the voting pattern. Now this table is very crowded and it's given in my paper, so you can look up the details in my paper. So I'm going to skip this table. And I have done all the 24 meetings here, all the details of the voting pattern. So I'll come to the summary of the 24 meetings we have had. So if we look across these 24 meetings, we had, if you look at the first column, we had 2 meetings in which we decided to increase rates. We had 9 meetings in which we decided to decrease rates. And we had 13 meetings in which we decided to maintain rates. Now, what I want to tell you also is that while we decided to change rates, like say decrease rates, but within ourselves, we disagreed on the quantum also of change. And wherever I have put the square bracket, it means that we uh, disagreed on the quantum of change. So we agreed on the action, but disagreed on the quantum. So it was a lot of fine tuning. Then at the same time, what we had to do was we had to also give the stance of monetary policy. So we had to give, is my stance accommodative? Is my stance neutral? Is it tightening? So if I say my stance is accommodative, I mean that I can keep interest rates constant or I will decrease interest rates. I will not increase it. So neutral means I can keep interest rates constant or I can increase or decrease. So it gives me flexibility to do whatever I like. And if my stance is tightening, it means that I can keep interest rates constant or I can increase interest rates. So we had to vote on the direction of change, the quantum of change, and what is my stance going forward. So this was quite complex. And then having done that, we have to see how this has impacted the economy. So what is the monetary policy transmission framework? So basically what we want is that a change in the monetary policy rate must impact inflation and growth. So again, just to go over the process, so we have an adjustment in the policy interest rate. This will impact the very short-term interest rate. This change in the very short-term interest rate will then transmit to other money market and bond market rates and the bank's deposit and lending rates. And then this brings us to consumption, investment, net exports, aggregate demand. So this is the way it is supposed to work. So here is a diagram showing you what is the monetary policy transmission. So monetary policy transmission, as I said, means we take an action in monetary policy. How does it affect the economic activity in the nation? So here, the mandate of monetary policy committees, you set the policy rate. So on the left hand side, you have the policy rate. Policy rate changes, the short-term money market rates change. When short-term money market rates change, all the financial market rates change, which includes all the money market rates, bond market rates, and we also change the bank deposit and lending rates. And then that affects our spending, consumption, investment, net exports. That affects the aggregate demand, and then we reach our goals of price stability and economic growth. Now, what I have shown you here is 5 different channels through which this change in the policy rate is impacting the rest of the economy. So one is the interest rate channel, which I have already explained to you. Then there is an asset price channel. So asset price channel means, like, suppose the interest rate is changed. Suppose we say we lower interest rates. Then it is possible that households may move towards non-interest bearing assets. So they may invest more in equities, they may invest more in housing. So demand for non-interest bearing assets will go up. So this would have something like a wealth effect, and the consumers would spend more. So that is the asset price channel. And also, if the price of equity goes up, firms may invest more. So consumption can go up, investment can go up. Then we have the exchange rate channel. So if the interest rate in our country changes, then our differential with the rest of the world also changes. And if the interest rate differential changes, then the exports and imports also change, and therefore that affects the aggregate demand in the economy. So that is the exchange rate channel. Then we have a credit channel. So if the interest rate changes, let us say, suppose interest rate drops, then that can affect the value of the debt obligations of firms, and therefore that can affect what the strength of the balance sheet of firms. So if interest rates have gone down, the balance sheet will start looking stronger, and therefore credit will flow to these firms. So financial institutions will be more willing to provide credit. So that is the credit channel. And then we have the expectations channel. So if we have expectations of the future policy rate, then that will change our expectations for short-term interest rates, medium-term interest rates, and therefore that is the expectations channel. So you can see the spectacular changes that are happening in the economy just by the Monetary Policy Committee setting a policy rate. Okay, so these are the 5 different channels that are not so obvious in the economy, but are playing their role and affecting aggregate demand. So with respect to India, here I show you just the interest rate channel. So on the left side, we have the change in the policy rate, and then that affects the very short-term money market rate, which is the call money market rate. So here we measure that by the weighted average call money market rate. Then that has an impact on financial markets, which includes money and bond markets. So we have the repo market, CD market, CP market, T-bill market, GSEC market, bond market. Then we also impact all the banks. We have the deposit rates, lending rates, marginal cost of funding, lending rate, which then also translates into a change in the weighted average lending rate. So what is the weighted average lending rate? the banks are lending to different sectors. So for each sector, you can have a lending rate, and then you can take a weighted average of that, which will give you the weighted average lending rate. Now there are two kinds of loans. One is a fresh loan. So if the policy rate changes, then for the fresh loans, that will be more responsive to a change in the policy rate. If there are outstanding loans, then the interest rate is already tied into that loan. So there will not be so much impact on loans which have already got fixed interest rates on them. So the weighted average lending rate on fresh loans can be responsive to the change in the policy rate. And here, let me also say, in the Indian context, for the monetary policy transmission, what has also been done is that the bank lending rates have been benchmarked to an external rate. So this was mandated by the central bank, and most banks have benchmarked their rate to the policy rate. So when the policy rate changes, their lending rate also changes. And so that makes the lending rate more responsive to a change in the policy rate. And then the rest of the story is the same effect on aggregate demand and economic growth. So to give you an idea of how this has worked in India, so if I take up to August 2020, so from starting from February 2019. So before the COVID-19 pandemic, we had a slowdown. So the slowdown, and that was a global slowdown. So there was a slowdown in India also. So between February 2019 and October 2019, the Monetary Policy Committee had decreased the interest rate by 135 basis points. Then after that came March. By March, we were experiencing the negative impact of COVID-19. So we had a meeting in March, and in that meeting, we cut the policy rate by 75 basis points. And this brought a total cut from February 2019 to 210 basis points. And then again in May, with the focus to give an impetus to the economy, we cut the interest rates again by 40 basis points. And this gave us a total cut from February 2019 to May of 250 basis points. But in the post-pandemic period, so between March and May, we have cut rates by 115 basis points. So monetary policy has been responding to this pandemic. And then what is the extent of transmission? It's not enough that we cut rates. So what I can tell you is that if we look at the weighted average lending rate on fresh rupee loans, so there was a decline of 91 basis points in this rate between March and June 2020. So in this pandemic period itself, it has been very responsive to the change in the policy rate. And also, as I said earlier, we now have the external benchmark system, and most banks have linked their lending rates for housing, personal, micro, small, and medium enterprises to the policy repo rate, and therefore the bank rates are now more responsive to the policy rate because of this mandated benchmark system. So here are some diagrams to show you how the interest rates are moving together. So the red line is the policy repo rate. Then the ceiling of this corridor is the green line, which is the marginal standing facility rate. The floor of this corridor is the reverse repo rate. And then what we are trying to manage on a day-to-day basis is the call money rate, which is this rust color line. So you can see the rust color line is moving along the red line. So that is how we have been able to control the weighted average call money rate. Let me also say here for all the students that my paper has an appendix with definitions of all the variables that I am covering in this presentation. So you can look at my paper and understand each of these variables. So here is a diagram for the GSEC market and the policy rate. Policy rate again is red. So I've taken GSEC market. GSEC instruments with different maturity, and you can see here that they're all moving in tandem with the policy rate. Then here are some lending rates of commercial banks, and what I want you to look here is the red line, which is the policy rate, and then we have the sort of blue line, which is the weighted average lending rate on fresh rupee loans. And then we have a mustard line, which is weighted average lending rate of outstanding loans. So you can see how the blue or the turquoise, whichever color you are seeing there, is moving along with the red line, but the mustard line is not moving along. So it is much easier to impact the interest rate on fresh rupee loans than outstanding loans. So here, now what I've shown you here is the CPI combined inflation up to date, and along with the 4 plus minus 2% tolerance band. So most of the time period we have been within this band. Now, recently, just before the pandemic, it went a little bit outside the band, and now, of course, the measurement of the inflation rate is not so clear. So we've had a couple of months when the inflation rate was imputed, so it's not really clear, which is shown by the dotted line here, whether we have the correct inflation rates. But yes, they have been high, and that is part of the shock that we are experiencing the world over. So here is another figure for the inflation rate against the CPI food inflation. Food inflation is given in red. This is just to show you that how much food affects the overall CPI inflation. So food has a major impact on our overall CPI inflation. Now here I have the figures for GDP growth, and of course it has not been very encouraging, and especially since 2019, even before COVID-19, we were experiencing a global slowdown. Okay, so given that we are in this crisis, can we deal with it using conventional monetary policy measures? Well, first of all, you cannot deal with it just using monetary policy, whether they are conventional or unconventional measures. You need to also use fiscal policy. That is one thing. But within monetary policy, there are conventional measures which I have talked about: open market operation, reserve requirement, policy rate, and so on. The point is that after some stage, it is not possible to decrease the short-term rate, or it is also not possible to, the rate does not respond to a policy action. So whatever the reason is, then we have to use some unconventional policy measures. The unconventional monetary policy measures that are used across the world are of four types. So the first such measure is the large-scale asset purchases. Now, large-scale asset purchases means that the central bank will purchase long-term government securities and financed by crediting reserve accounts that commercial banks hold at the central bank. So now these commercial banks will then have excess reserves. So commercial banks can then use these reserves to invest in private sector bonds also. So the idea is that if you purchase long-term government securities, you can have the effect of lowering interest rates without actually lowering the policy rate. So you can have the same effect. So have we used this in India? Yes, we have used this in India. We have used this as operations twist, and the central bank has used this in December, January, and also more recently now in August. And what it does is it purchases long-term securities and at the same time sells short-term securities. So the effect of this is to flatten the yield curve, and this is what RBI has been doing. Then another way is that the lending operations. So lending operations are not the same as just giving a loan. Lending operations means that you are doing something to create or extend the existing lending facility. So it's not just the conventional lending, you're lending at an expanded set of collateral, or you're lending at a lower cost, or you are extending the maturity of the loan. So you're making borrowing easier. And this also includes you are lending a targeted sector. So if there is a particular sector that you want to target growth in, then you're lending to that sector. So this has also been used in India by Reserve Bank of India. So this has been done in terms of their long-term repo operations, and also more recently the targeted long-term repo operations, and also the sector-specific refinance facilities it has given to NABARD and SIDBI, and also the National Housing Bank. So all of these have been used since February, March, April, and even more recently. So all this is just before the pandemic and after the pandemic. Then another unconventional measure is forward guidance. Now, forward guidance is not always unconventional. So, forward guidance is given routinely by a central bank. So, it states the intentions and commitments regarding the policy rate. And the central bank always gives some idea that we are going to keep interest rates constant, or if you look at the MPC minutes, that growth is very important to us. But these are routine guidance given. So when it is an unconventional guidance, it refers to a substantive change. So it has to be time specific, means that for the next 1 year we will not change interest rates, or it could be state specific, that until the economy revises we will not increase interest rates. So something like that is an unconventional forward guidance. And this has also been used. If you look at the statements of the RBI governor, you will find that extraordinary policy actions have been taken, and for a much longer duration than is common to take. Now, the last unconventional measure that is used in other countries is a negative interest rate on the reserves that banks hold with the central bank. And the idea is to dissuade banks from holding reserves with the central bank, and to persuade the banks to lend to the private sector. But this has not been used by India yet. But India has used the three other unconventional monetary policy measures. And therefore, in terms of policy, it has used conventional monetary policy, it has used unconventional monetary policy. Monetary policy on its own is not sufficient, so we have needed fiscal policy, which also the government has provided. Now, what I want to very quickly take you through is the comparison of the MPC in India with the MPCs in other countries. Like here, as I explained, each member is very accountable. An individual statement is given at the end of the meeting. On the 14th day of the meeting, this statement is made public. So how is this compared to other countries? What has happened in MPCs in other countries? Now this table is very crowded, so all this data is given in my paper, but if you just focus on the left hand side, you will find that it is normal not to have a consensus in the committee meetings in various countries. So here I've divided this continent wise. So whether you look at Asia, Europe, Asia, Middle East, North America, Oceania, South America, I've picked up some countries and shown you that it is quite acceptable not to have a consensus in the monetary policy meetings. And now what I want to show you is how globally there was synchronization in the policy cuts. So India, I have already told you the policy cuts. Now if I look at all the other countries, so during this period, so this is the 2019, post 2019 period, the table says October 2018, but there was no action in 2018. All this reflects 2019 and 2020. So in South Africa, we have seen an interest rate cut of minus 325 basis points. In India, of course, I've told you 250 basis points, Thailand 125 basis points, Czech Republic 200 basis points, Russia 350 basis points, Canada 150 basis points, US 225 basis points, Brazil 450 basis points, and Chile and Colombia 225 basis points. So whichever part of the globe you see, you can see that policy rates have been cut, and this is a synchronized cut in interest rates across the world. So here I just want to show you how policy rates have moved in different countries. So these are the BRICS countries, and you can see here India is the green line. So you can see that all the policy rates are falling in this. Then here I have some of the developed countries, US, ECB, UK, and Japan. So apart from Japan, you can see that the policy rates have dropped in all other countries. Then inflation targeting. Now, if I look at inflation targeting, India adopted an inflation targeting regime in 2016. So, is this a robust regime? Now, if you look at the timeline across the world, so here I've drawn a timeline across the world by looking at the timelines of various countries. So, this approach to inflation targeting was first adopted in 1990 by New Zealand, and it is still on that framework, which means there must be some confidence in this framework. And along the way, so many other countries have also adopted the monetary targeting framework. So here, India entered this scene in 2016, but before that, many other countries have joined. So this is a robust framework to adopt. And okay, just to give you an idea of how inflation has moved across the world. So this shows you for various countries, and you can see quite a lot of similarity in the trends in inflation across the world. And here is the similarity in GDP growth. You can see the sharp decline in GDP growth in all countries that are shown here. So what I have tried to do here is to show you what is the genesis of the monetary policy framework in India, what is the monetary policy framework that it adopted in 2016, why is this framework important, and also how does this framework compare with the rest of the world. So what we find here is that it seems to be a robust framework, and the kind of voting pattern we have found in India is consistent with what we find in the rest of the world. Inflation targeting has been experimented with various countries, and the amazing thing is, in this unprecedented, extraordinary crisis, the entire world is moving together, trying to give its very best to revive economic activity, mitigate the impact of COVID-19, and to restore financial stability in their own country. So across the world, this attempt is being made, as you saw with the synchronization of the decrease in the policy rate. And also I have explained to you the monetary transmission process, how in the background we have 5 different channels working, and we don't see it so obviously, but so much is happening when one interest rate changes in the economy. So this is where I will end. My article is available on this link with all the data that I have presented to you, and also definitions of each and every variable, plus a lot more variables that I have referred to in my presentation. So thank you very much.